When thinking about the tax planning decisions that affect your investments the most, a lot of the times people focus solely on the rate of return on the investment portfolio itself and not enough on what the actual take home after tax rate of return is, which is really what you want to focus on because that's what you've actually made. For us, there's five things that come to mind. The first one is timing, right? When you sell, when you take certain amounts of income, taking them in the right years, taking them in the right time has a huge impact on what your after tax return might be. Prime example, capital gain decisions, when to sell, when to rebalance. A lot of times people do this either accidentally when they think about it, when the market happens to be up or down, they do it out of fear because the market's down or something like that without really thinking about how it impacts the taxes in their tax return. Another one is tax loss harvesting. In the right years, tax loss harvesting can be a great tool. It can save you a lot of taxes. If you do it without a plan, it can sometimes not give you the benefit that you think it's giving you, and maybe you would have made a different decision had you thought more about it. Another one, a big one, is net investment income tax. So a lot of people don't even know this tax exists. It's for people in slightly higher tax brackets. Essentially, you can end up costing yourself taxes by taking capital gains in a year in which you have high income, when you might have been able to save that tax money just by waiting a few more months and getting into another year when you might have lower income. So understanding how these different taxes work together can be a huge impact to the after-tax return. Another huge one, Roth conversions. So Roth conversions, you can convert some of your IRA money into Roth money and save taxes down the road. In certain years, that makes a lot of sense, right? In years in which you have a very low income, you can do it with little or no tax and reap the benefits later. Or in years in which the market's down significantly, if you convert the Roth money when the market's down, the recovery can all be tax-free later. If you do it in the wrong years, you can end up costing yourself taxes, paying a higher rate now than you might have paid down the road. So just understanding how all these things work together is really what it's all about, and maximizing that after-tax rate of return. These tax planning approaches don't just impact the tax return, they can also impact what decisions you make at certain times. So just understanding how they impact your decision making and understanding how it impacts your taxes and how those two things work together is really what it's all about.